G'day there. If you have a home loan and you've ever wondered, well, what is the best way to set up my bank accounts so that I can manage my money better and hopefully save more money, then this video is absolutely for you, because in this video, I'm going to share with you the ideal bank account structure that I've used with my clients for over 30 years to help them master their cash flow and, most importantly, save themselves literally hundreds of thousands of dollars in interest on their home loan. G'day there, my name is Phil McGilvray. I'm a financial coach, financial wellbeing consultant, and founder of the Money Boss movement, where we make financial education fun, practical, and easy to understand so that you and your family can thrive financially. And today, we are looking at the ideal bank account structure, or more specifically, the ideal bank account structure when you have a mortgage. Okay, so let's get stuck into this using some very simple diagrams. There are 3 bank accounts that ideally you should have as a homeowner. We'll go through them one at a time. The first one is the central working account. This is your main operating account that should receive all sources of income into your family. So if you're a couple, that means his income and her income coming into this central account so that you are harnessing it as it comes through that one doorway into your financial world. In this account, we hold all the money for our known upcoming expenses. So if you have a budget, then the budget will tell you exactly how much needs to be in this central operating account. If you don't have a budget, then ideally what you're looking for is about 1.5 times your average monthly expenses sitting in this central account on the last day of each month. And from this account, we have all of your expenses go out. So you can see on the right-hand side here, the direct debits, the periodical payments, the transfers. Ideally, you have a debit card attached to it. And if you have a credit card, this is where your credit card should get paid from. What this allows you to do is have one statement there where you can see, here is all the income that we've had come in, and here is all of our expenses, because then you can see exactly what's going on in your financial world. That awareness is so important to help us manage our cash flow more efficiently. So that is the first operating account. The second account then is what I call your everyday account. One of the biggest areas of waste in our culture is spending on what I call the everyday consumables. So this is things like groceries, petrol, parking, entertainment, bought coffees, bought lunches, takeaway, cigarettes, alcohol. These are the areas that we tend to waste or leak so much money every single month. So what I encourage my clients to do is to isolate this one category of expenses into a separate everyday account, an ATM account, an FBOS account, where you've got a card attached to it, and you can isolate your everyday spending money in there on the first day of each month. And then you say to yourself, this is what I've got for the month. I need to make it last. And if it runs out before the end of the month, bad luck. We're on to baked beans and mashed potatoes for the rest of the month. So having that isolated account helps you pace your spending throughout the month and eliminates the risk that you're going to overspend. This is a really powerful and practical way to help limit that consumable spending. So that is your everyday account. Then what we've got, the third account, is your high interest savings account. So this is where we save money for your rainy day fund. Now, your rainy day fund is to cover your unexpected expenses. This is things like the fridge breaking down, the car breaking down, the dog getting sick. I had a client the other day, both her dogs got bitten by the same brown snake. So as a result, she had to pay $2,000 in antivenin for both dogs. There are all sorts of reasons why you would have an unexpected, a rainy day fund to cover the unexpected expenses. Just this year in my family, we had our dishwasher die, we had our hot water system die, and we had to replace the pads in our evaporative air conditioning. In total, that all cost us about $8,000. So if we hadn't had a rainy day fund, we would have been in trouble. Any one of these expenses could have happened 5 years ago, or they could happen 5 years in the future. I don't know when they're going to happen. I know they'll happen at some point. So the rainy day fund is a catch-all to make sure I've got money set aside so that when those things come up, the money is just there ready to go. So that is the first use for this high interest savings account. The second use for this high interest account is to have a cash reserve. Now, the cash reserve is there for unexpected life events. So things like I get sick and I can't work. I get injured and I can't work. I lose my job, or I need to stop working so that I can care for a loved one. There's all sorts of reasons why having a rainy day fund will give you that peace of mind. So having your high interest account so that you're earning interest on it while that money sits there is really important. Now, typically, I do not believe that cash is a good investment, except in this situation where it's to provide you with peace of mind, knowing that you've got the unexpected, both in terms of life events and unexpected expenses covered. The third reason that you might use this high interest account is setting money aside for big long-term life goals. Things like money aside for buying a car, money aside for buying a house, money aside for taking the family overseas, or perhaps a kid's education. Having that sitting in a high interest account, earning you money while you're waiting to spend that, can be a really good thing to do. So that's a 3 bank account structure that we need to be looking at. I'm hoping you can see here that every dollar has a purpose. In this central working account, we only have enough money to cover our known upcoming expenses. If we've got more in that account than we need, then we transfer that up. If we need it in our rainy day fund, that's a set amount. You decide what that amount is. If I don't need it there, do I need it in my cash reserve? If I don't need it in my cash reserve, then I can start putting it towards my big life goals or investing. There are 2 other bank accounts that we may need, and that is, if we're a couple, we may want a his and hers completely discretionary pocket money account. Now, this is purely discretionary. This is money that you don't have to have any accountability for. You can give it to each other and you can spend it however you like, but it should only be a very small amount of money, because in reality, most of your expenses should be covered in your central working account. So that's just 2 other accounts that we may want to have in this occasion. Okay, so let's now have a look at, well, how does this apply in terms of my home loan? And that is, we are going to use, or basically replace, those 3 main accounts with offset accounts. Now, a couple of weeks ago, I did a video on what offset accounts are and how they work. I would encourage you to go back and have a look at those, but let's have a look at how that applies to our ideal bank account structure. The average Australian mortgage right now is an eye-watering $600,000. Interest rates are sitting at around 6%, which means that our annual interest is about $36,000 on that home loan. But what if I actually was to set up a savings offset account? So this is one type of offset account. It's a savings account. There's no bells and whistles. You can transfer money between your savings offset and one other, and this would be your central operating account. You can't transfer money from it in any other way. There's no cards attached to it. You can't direct debit from it. It's just purely a savings offset account. And this is to replace our savings account where we have our rainy day fund, our cash reserve, and our big life goals. We can then have another offset account, which is called an everyday offset account, which does have all the bells and whistles. It does have a debit card. It does allow you to do periodical payments and direct debits, and it does allow you to transfer money wherever you like. So having your everyday account as your central operating account as an everyday offset is a really, really smart move. And then the third account, our everyday account, can also be an everyday offset. Now, if we look at that, let's just say we had $20,000 sitting in our savings account. We now put it into our savings offset. Let's say that all of our expenses, our known upcoming expenses, we've got $15,000 accumulated. And let's say our everyday account has $2,000. If we add all of those up, that comes to $37,000. So from the bank's perspective, that means that they only see $563,000 as owing on your home loan. So there's only $563,000 that you have to pay interest on. And that equates to $33,780 in interest. So you can see what we're doing here is, by having this money sitting in these accounts here, this $37,000 in total, we are saving ourselves $2,220 per annum in interest. This is really powerful. Now, you might not think $2,220 is a whole lot, but let's have a look at the impact of this. This is a mortgage calculator on my Grandma's Jars website. You can see that if we had $601,000, which is the average Australian home loan, and we put this $37,000 into offset accounts from day one in our mortgage, and let's say it's a 30-year mortgage, we would actually end up paying our mortgage off simply because that money's sitting in offset accounts. And yes, we're using it, and yes, that $37,000 will go up and down every week, every month, based on where we're at in our spending cycles for the month. but it will save us 4 years, 5 months off our mortgage. We'll pay our mortgage off 4.5 years earlier. But more importantly, it will save us $156,796 in interest over the course of that loan. That is a huge amount of money that you get to keep, which is so valuable to you, simply because you had this bank account structure set up. Now, of course, if you have a bigger mortgage, or if your interest rate's higher, or if you have more sitting in your bank accounts, the benefits of this would be even greater. Now, I'm hoping you can see the power of this, but let's have a look at the 3 really big benefits of an offset account. First one is an offset account gives you a higher return. So you're saving 6% in interest on your mortgage, whereas if you had that money sitting in a bank account, a high interest account, you're only earning 5%. So there's already a 1% difference between having money in an offset account and having money in a savings account. The second thing is that having money in your offset account will actually save you tax. Because if you think about it, when you save money on your mortgage, you're saving at 6%. So a $100,000 mortgage, you're saving yourself at 6%. You're going to save yourself $6,000 for the year, which is huge. And you go, okay, $6,000 I've saved, but because you've saved it, you don't have to pay tax on it. But if I were to earn that same $6,000 in a savings account, I would have to pay tax on it, which means I'm probably going to lose about 1/3 of that money. So much better to have your money in an offset account. And the last reason is it helps you keep your home loan sacred. So often banks will try and tell you that a redraw is the same as an offset account. Mathematically, yes, they are, but behaviorally, they're completely different. You don't ever want to be dipping into your home loan to pull out money you're ahead on, because once you do it once, you do it again and again and again, and the banks know that you will end up having your loan for 30 years because you keep dipping into this to get the new car, and you keep dipping into every time, the credit card's a bit bigger than expected. Please don't do that. Your home loan should be sacred. It should only go in one direction, and that direction is down. To allow us to do that, we have this offset accounts over here where we have money set aside, for our rainy day fund. We have money set aside for unexpected life events, and we have our big life savings goals in these offset accounts. Anything over and above what we need there can go off the mortgage, knowing that it will stay off the mortgage forever because we've got all our contingencies covered over here in our offset account. So having offset accounts will help you keep your home loan sacred. Now, there are just a couple of things that we need to be wary of with offset accounts. So you need to be asking the right questions here. The first one is, often they will try and charge you a high interest rate with if you have offset accounts. Just make sure, many of the providers don't do this, some of them do. Ask, am I going to have to pay a higher interest rate? And if you are, it doesn't necessarily mean you can't use them, but just make sure that what they're charging you in interest isn't going to be more than what you're saving by having money in those offset accounts. If they're charging you an extra 1%, and that's going to cost you an extra $6,000 per year on your mortgage, but you're only saving $3,000 over here by having all this money in your offset account, it's not worth it. So just make sure that you know the numbers first. If they're going to charge you a higher interest rate, make sure it's not too much, and make sure that you're still making more money by having money in your offset accounts. The second thing that you need to be aware of, are they charging increased fees? The banks will get away with what they can. Just make sure they're not. Often you can negotiate these down if they are trying to charge higher fees. And the last one is, some of the banks have sneakily decided to start not offsetting 100%. So that means that for every dollar you've got sitting in your offset account, a traditional offset account will save you, basically the bank will consider $1 off your mortgage. But more recently, they said, well, for every $1 you've got in your offset account, we're only going to pretend it's 50% of that. So 50 cents off your mortgage. Please don't allow that to happen to you. Make sure that you know that your offsets are 100% offset. That's the question you need to be asking. Is this offset account 100% offset? And if it is, fantastic. You've got a good product. So again, what we're looking for now is 3 bank accounts. One is a savings offset account that we can have our rainy day fund, our cash reserve, and our future goals in. We want to have an everyday offset for our central operating account, and we want to have an everyday account for our everyday transaction account. That will save you a significant sum of money every year on your mortgage, and over the course of your loan, potentially hundreds of thousands of dollars. So I hope this has been helpful. If it has, please click the like button because that helps my videos reach more people. And please subscribe because every week I release more videos with practical, fun, easy to understand financial education so that you and your family can thrive financially. I truly believe that little habits and strategies that we put in today can literally make $1 million difference to our future. So click the like, click the subscribe, and I look forward to seeing you in the next video.